What's up, everyone? It's Caddy with Money Investing. So, wanted to talk a little bit about the employment report from today and how that actually plays a role into the Fed's thinking in terms of interest rates going into next week and remainder of this year. So, I want to go over the dual mandate from the Federal Reserve and what their actual goals are, and I'm gonna go show you some text and some visuals on where they believe the maximum employment and stable prices. What does that actually mean? And why this employment report that we just got today is still insignificant as to what the Federal Reserve is going to do next week. So, hope you guys enjoyed this video. Well, actually, not next week, on March 22nd, when the next FOMC meeting is. So, hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord and Patreon is going to be down below. If you're interested in joining us, we'd love to have you on board with over 3,600 members. We're talking about fundamental and technical analysis pretty much all the time, and along with stocks and options and macroeconomics as well. So this right here was the actual employment report, right? So 311,000 jobs added, and the unemployment rate ticked up from 3.4 to as much as 3.6%. So this is a good, decent tick up, right? What does that mean? That basically tells us there's more unemployed persons now than there were last month because of how many are now unemployed. We're seeing a little bit of a tick higher in the unemployment rate. I talked about how we can still have the unemployment rate move higher even though we're adding jobs month over month. So even though we added 311,000 jobs, which is still a really, really hot labor market, that's a lot of jobs being added, unemployment rate did tick up from 3.4 to 3.6% because of the new entrance in the labor workforce. People actively seeking work has increased, and as a result, we're seeing unemployment rate push higher. But 3.6%, if you think about it from historical measures, is still a really, really low number. And if you come over to their own monetary policy, what are their goals and how does it work? They've pretty much mentioned that the FOMC explains in a public statement how it interprets its monetary policy goals and principles that guides its strategy and achieving them. FOMC judges the low and stable inflation at the rate of 2% per year as measured by the annual change in the price index of the personal consumption expenditure. That's the PCE. That's what the Federal Reserve focuses on. And they didn't really mention a rate for unemployment, in other words, maximum employment. They mentioned to assess maximum employment level that can be sustained, the FOMC considers a broad range of labor market indicators, including how many workers are unemployed, underemployed, or discouraged and have stopped looking for a job. So FOMC does not specify a fixed goal for employment because the maximum level of employment is largely dependent by non-monetary factors that affect the structure and dynamics of the labor market. So they don't necessarily have a goal, in other words, a percentage in mind. However, if you come over to the Federal Reserve Bank of Chicago, what they have is a bullseye chart. I've actually shared this in my previous videos not too long ago, talking about this chart right here, which is the dual mandate bullseye. And what this shows us is a y-axis and an x-axis, pretty much telling us where the Federal Reserve needs to hit on their monetary policy objective, both on an inflation standpoint and on an unemployment standpoint. So what you'll notice is that on the y-axis, we've got core inflation sitting at 2%. And on the unemployment rate, on the x-axis, we've got as high as just over 4%. So you can kind of come down here. 4% is this number right here. 5% is over here. So they're bullseye targets. If you go across, or pretty much go across 2% and go up, and this is their bull target. That's the black pretty much dot. That's what they're trying to achieve with their monetary policy in terms of their dual mandate. So yes, there is a dual mandate the Federal Reserve really very much cares about. They want stable prices and maximum employment. But right now, you know where we are? We are over here. So if I pretty much draw a circle in this, so let me just draw this very quickly. I'm gonna color this up so it's beautiful looking. So we're going to do that. We're going to remove the boundary. And this is where we are. So we're at very, very low unemployment. We're at 3.6, 3.5%. But we're like somewhere over here. Probably we have to go even further up. Like if there was any space, I would be going further up. Why? Because inflation is all the way out here. So if I include some text here so it becomes a lot easier to understand, this is the actual inflation sitting at, core PCE probably at around 4%. I can't remember my last count. I think it was closer to 3.6, 3.7. Around those numbers, we're going to call it 4%. And then unemployment obviously much lower at 3.6%. This is where we are. So we're definitely a lot higher on this y-axis and we are lower on the x-axis. In other words, this is where we are. Now, the Federal Reserve, their eventual goal is to move this dot down here, right? They want to actually move, well, ideally, they would just want to move it straight down. Why? Because they want to bring inflation down while keeping the labor market tight and unemployment at a 50-year low. But they're not going to be able to do that because eventually once they start raising rates and how they have been raising rates in the past year, something's going to break and we're already starting to see things breaking apart with Silicon Valley Bank, with Silvergate. We've got a lot of tech employees getting laid off. So things are starting to ripple into the economy and we are seeing some cracks in the economy. Money supply is contracting. Consumer spending will start to deteriorate as the savings rate has depleted and we're kind of running short on excess savings as well. So eventually things will start to deteriorate. And what happens is the goal for the Federal Reserve, ideal goal, like the most preferred goal would be to just bring this straight down. So bring inflation down without hurting the labor market. But we know that's not going to happen. So the best course that they chart moving forward is straight down here, right? They just want to move down here. So even if there is softening in the labor market, even if it goes from like 3.6 to 4%, they're willing to accept that. They're willing to let that slide in order to get inflation back down. But what are obviously some of the other scenarios that could happen, right? There's a scenario, which is the worst case scenario that I pointed out in my other video when we talked about the dual mandate, is if we end up all the way here at the top right. So we go from top left of this dual mandate bullseye to top right. What does that tell us? That tells us we're dealing with an environment which is high in inflation and high in unemployment. The Federal Reserve, this is the worst place to be for the Federal Reserve from a visual standpoint. This is really not the place they want to be, especially anywhere in this top right quadrant is the worst place for the Fed because you're dealing with not only high inflation, but you're also dealing with high levels of unemployment. And in this top right quadrant, what happens is the Federal Reserve will have to make a decision, right? Do they raise rates? Do they cut rates? Because that's the dual mandate. It's kind of fighting against each other, right? We've got raising rates will help inflation hopefully come down, but raising rates is not going to help the unemployment situation get any better, right? So if they cut rates, yes, that's going to help the unemployment rate, but it's going to really put a dent on inflation. It's going to probably make it go higher even more. So their top right quadrant is the worst place for the Federal Reserve to be. And right now, this is where we are. We are in the top left quadrant. And it doesn't take long for us to go from top left to top right. It's much easier to go from top left to top right than it is to go from top left to bottom left, right? Which is where the Federal Reserve would ideally like to be with lower inflation and lower unemployment, right? Price stability and, inflation kind of staying between 1.5% to 2%. And of course, employment even under 4%. So given where we are right now in this bullseye chart, if you come over to their own estimates of what they believe is going to be the goal, they've mentioned that unemployment rate, as seen over here in their most recent summary of economic projections from back in December, they suggested that 2023 unemployment could get up to 4.6%, right? And they mentioned that it can be at 4.6% throughout the next couple of years, 2023 and 2024. Inflation, they're expecting for it to come down to 3.1%, which would be ideal. And by 2025 to 2.5%, we'll see if that actually happens. But one of the things the Federal Reserve pretty much mentioned is that if they're expecting, right, if they're actually expecting federal funds rate to be higher than what they previously anticipated, and literally if you go back and check out the testimonies from Jerome Powell, what has he mentioned? He mentioned that number one, the rates are going to be higher than what we previously anticipated. Well, this is their anticipation from the past. This is from December 2022. Last time the SEP came out, Summary of Economic Projections, they were expecting 2023 rates to get up to 5.1%. Now, if Jerome Powell is telling us that interest rates are going to be higher than what we previously anticipated, we can assume that it's going to be higher than 5.1%. And as interest rates are going to be higher than what they previously anticipated, we can also assume that unemployment rate is going to be higher what they previously anticipated because higher interest rates will directly affect jobs, right? It will affect cost of borrowing, which will affect consumer spending, which will affect jobs one way or another. So if we get up to 5% for unemployment, the Fed better hope that inflation comes down to their target, if not lower, because if it doesn't, then there's a high probability that we end up in this top right quadrant for this, dual mandate bullseye. Because if we get up to 5% unemployment, we're over here, and inflation doesn't come down, right? So bottom right is still better than top right. Bottom right is going to be higher unemployment, but lower inflation. the Fed better hope inflation comes down. If it doesn't, then we're probably over here and we're moving in a much worse sort of situation where unemployment stays higher, it goes higher, and inflation also continues to either stay elevated or continues to push higher as well. Let me know your thoughts on this. Let me know where you think or believe we're going to be in this dual mandate bullseye, which quadrant you believe, like number 1, number 2. So I'm gonna mark these out so you can kind of put that in the comments. So number 1, we're gonna put number 2 over here, and we're gonna put number 3 down here, and then of course the worst quadrant B for the Fed and for the economy, number 4. So let me know what your thoughts are, and which quadrant you believe the Federal Reserve is eventually going to put us with respect to inflation and unemployment. Now, once again, we're back over to 50 basis points, rightly so, because like I said, this is still a very, very tight labor market, and this unemployment tick higher should really not be the reason for the markets to once again pricing in a 25 basis points, because like I said, we're still flexible enough to get the unemployment rate higher. I mean, this is still a very tight labor market, and the Federal Reserve themselves have mentioned higher than expected interest rates and more softening of the labor market is welcome, considering that they're trying to balance out the demand and supply in a labor market as well. So in order to get us down to that level, they're welcoming the higher levels of unemployment. And as a result, I think rightly so, the market's back up to a 50 basis points potential high on March 22nd, and for the rate to get up to over 5 to 5.25%, in line with what the Fed also suggested. But this is completely chaotic right now. The market definitely is very much in complete chaos with respect to what the Fed funds future is going to look like. So right now we're still kind of pricing it. And now the rate probability for us to get up to over 6.25 to 6.5% is insane, 35.7% by November. And this is where we are as of today. The probability has absolutely skyrocketed in the current level here for the Fed funds futures for us to get up to 6.25 to 6.5%. If rates get up to that level, then you better believe it, unemployment is going to be much higher in that environment as well. So again, let me know in the comment section down below which quadrant you believe we're going to probably end up from this dual mandate bullseye. As always, if you enjoyed this video, a little bit more educational, but also going over my thesis and my sort of analysis, I do believe that everything rides on the inflation report for next week. So depending on how CPI and PPI comes in, we're going to kind of shift on our expectations for March 22nd. But I think right now, as it stands, 50 basis points is pretty much likely and also appropriate from the Federal Reserve, considering that unemployment's only softened a little bit and we're nowhere near close to the Fed's optimal target of over 4% unemployment. So hope you guys enjoyed this video. Find it helpful. If you did, make sure that you drop a like, subscribe to the channel. As always, happy investing, and I'll see you all in the next video.